Crypto regulation just stalled in Washington for one reason. Stablecoin yield threatens the banking deposit model. That's the fact. That's what's really behind this. Today, the Senate hit pause exactly where the traditional funding structure starts to fracture. The Clarity Act markup was postponed, if you didn't hear already, and not because crypto is too complex, but because stablecoin rewards change the economics of deposits and threatens the entire banking system. Once a digital dollar can pay something close to what treasury bills pay, the deposit game shifts fast. And that's why this matters for your stack this week, and that's why we're gonna cover it. So in the next few minutes, I'll show you the single sentence in the draft that triggered the fight. We're also gonna get into the $6 trillion fear sitting behind the scenes and the two market signals that showed real buyers didn't care about the policy noise. So by the end of today's video, you'll understand what's actually driving this standoff, why banks are nervous, and what to watch next so you don't get misled by headlines. So let's get into it. Here's what happened. The Senate Banking Committee postponed today's markup for the Digital Asset Market Structure Bill. Chairman Tim Scott framed it as a pause, emphasized negotiations are ongoing, and said all parties are still at the table. That matters. This is a negotiation problem, not a dead bill. But the timing is what made this explosive, if you've noticed. This pause didn't happen on a quiet news day. It happened right as the largest regulated US crypto company stepped back. Coinbase CEO Brian Armstrong publicly said Coinbase cannot support the Senate bill as written. He pointed to three issues: a de facto ban on tokenized equities, restrictions on DeFi, and stablecoin rewards language that favors banks over competition. I'm so happy to hear that he stepped up. The moment Coinbase says, "We're out," the bill stops being a victory lap and becomes a spotlight. As it has. Who is this bill really protecting is the question. The reaction was immediate. A viral post claimed the Senate killed the act after Coinbase pushed back, tying the delay to no stablecoin yield and no real DeFi freedom. The tone was heated, but the emotional read was accurate. The market heard one message clearly. Banks just drew a line. So what was the line in the draft that triggered the fight? Well, this is the core issue. Draft language stated that companies cannot pay interest simply for holding a stablecoin balance. Rewards are allowed only when tied to activity, things like transactions, staking, liquidity provision, collateral posting, or governance participation. Passive yield is out. Activity-based rewards are in. Your translation? You cannot just hold a digital dollar and get paid. That one sentence sent ripples throughout the market because stablecoins are backed by reserves, and those reserves often sit in short-term treasuries. Treasuries pay real yield, and banks have built an enormous business on paying depositors very little while earning much more on the back end. So this is not a technical detail. This is a moat. This is the legacy system trying to prevent yield from flowing through to you. This is disrupting their entire business model. And the Clarity Act didn't pause because crypto is complicated. It paused because it touched the most sensitive part of banking. As I said, their entire business model, meaning deposits, funding, and spread. And that brings us to the $6 trillion number. Bank of America CEO Brian, let me say his last name correctly, Moynihan, warned that up to $6 trillion in deposits, which are roughly 30 to 35% of US commercial bank deposits, could migrate into stablecoins under certain regulatory outcomes. He also warned that deposit losses would pressure banks' ability to lend and force them into more expensive funding. That is the quiet part said out loud. Stablecoins are not just crypto toys. They are competing rails for the very dollar, competing pipes for yield, competing infrastructure for payments. So when draft language blocks passive stablecoin yield, it is protecting the bank funding model. Crypto saw it immediately. Dragonfly partner Omar Kanji summarized the warning bluntly. Consumers shouldn't earn yield, so banks can keep it. He framed the fear exactly as it is: deposit flight and the loss of cheap funding. That was aggressive phrasing, yes, but correct incentives. One chart made it obvious. FDIC average rates showed savings around 0.39%, checking near 0.07%, money markets around 0.58%, while Treasury yields sat near 3.9%. That gap is the spread. That spread is the profit. That profit is what banks defend. It's their lifeline. The Clarity Act ran straight into the deposit dam. And when that dam looks like it could leak into stablecoins, the lobbying intensifies and coalitions fracture. So here's the part traders and investors, such as myself and yourself, care about. Even with all that noise, Bitcoin didn't flinch. And the flows tell us why. Markets don't wait for Washington. On the day this drama hit, the total crypto market cap still rose about 1.1% to roughly $3.37 trillion. And trading volume hovered near $166 billion. Bitcoin held near $97,000, just a minimal dip. And Ethereum traded around $3,300, with the Fear and Greed Index sitting at about 54, which is neutral. That combination matters so much. Strength without euphoria. But the real scoreboard was found and is found in the ETF flows. US spot Bitcoin ETFs pulled in roughly $844 million in flows. Spot Ethereum ETFs added $175 million approximately. That's institutional conviction, while politicians argue over commas. Here's the punchline. Policy noise was loud. Capital flows, though, were louder. And if banks are lobbying to contain stablecoin yield, that tells you the threat is real. You don't lobby against irrelevant technology. Coinbase's stance also matters for a second reason. This wasn't just about yield. The bill also restricted tokenized equities and DeFi in ways major industry players refuse to accept. So you have two forces moving simultaneously is what we see. The legacy system on the one hand trying to preserve yield and compliance choke points on the other. All while capital is allocating anyway because Bitcoin does not need permission. That's why this episode is bigger than one committee markup. This pause is not bearish. It's an incentive reveal. Stablecoin yield is the red line. The next draft will tell you everything. Do they keep the ban on passive interest? Do they soften it? Or do they carve out a workable lane? That decision determines whether this bill is actually clarity or a walled garden. Coinbase's posture is another signal, because when the largest regulated exchange says no bill is better than this bill, it tells you the industry won't accept clarity that freezes innovation. Your market scoreboard stays simple. Flows. ETF inflows are the adoption meter. As long as they remain positive, supply tightens and the market has a cushion. Positioning matters here. Keep core exposure sized so you can sleep. Treat round numbers as psychological zones, not invitations to overtrade. Watch the stablecoin yield language and DeFi hooks. They're the magnets pulling this bill towards bank-shaped finance. And reduce counterparty risk. This entire episode is a reminder that systems protect themselves first. Custody matters. Self-custody exists for a reason. This fight is not just technical, it's cultural. Freedom versus gatekeeping. Open rails versus controlled pipes. And that's the fault line beneath the policy fight. So as we close out, here's the bottom line. The Clarity Act didn't move because the fight got real. Stablecoin yield touches deposits. Deposits touch bank power. That's the chain. Coinbase pushed back. The coalition cracked and the committee paused while the market gave you its verdict in real time. ETFs bought size. Capital moved while the old guard argued over who keeps the spread. This is what structural change looks like, guys. Close up. It's messy, it's political, yes, it's loud, and it's happening anyway. So stay sharp, stay connected, keep following me, follow the money, which is what we do here at my channel. Watch the yield line, watch the next draft, Watch the flows. And if you want more breakdowns like this, subscribe, and of course, like the video. It's so encouraging to me. Every single like, every single comment, you have no idea. And also let me know what other topics you'd like me to cover in upcoming videos, and I'd be so happy to look into it for you. I love you guys so much, and I'll catch you guys here tomorrow. Ciao.